Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got Chris Zhang back on to talk through the market shifts and changes that have happened basically in the first part of this year so far. It's a story of a continued swing of what we were seeing at the end of Q4. But very fascinating in that we may be close to finally sticking a soft landing. But despite all that, there's still this commercial real estate bomb sitting out there somewhere. And we don't know how that's going to shake things out. So here's Chris with his take. All right. Welcome, Chris. Good to have you back.
Good to be back, Mark.
So our last stop of you on the pod was December 23. So things have changed. We're a few months beyond. Fair bit to catch up on. You want to bring us up to speed?
Yeah, Mark. It's a lot has happened, but at the same time, is the best way I can frame this is market has been pretty one-way street, and really the reactions all happened pretty much around our last call, and it's been a sort of same trend following trade pattern ever since in really global markets. And I'll dissect all of that, and I want to dive into it a bit more. But basically, the last time we chat, the Fed just had a meeting, and the whole market was waiting on whether they're going to cut in January. Market was clearly jittery and uncertain leading into it, which is why it ultimately became a bit of a shock. Maybe a few weeks before the January meeting, that it was clear that the Fed is signaling that it wasn't going to cut. There was a bit of a letdown and disappointment, but it was very short-lived. At least in the equity market. In the interest rate, sort of really outside of equity market, fixed income market, what seems to me, the participants there are a bit more rational. The rate cut expectations has been dialed down significantly. If you remember last time we chat, market were really expecting about 6 cuts this year. Now the expectations came down to 3, which I think is that's way more reasonable. And if you just plot out how many meetings are left in the year and which ones are generally considered active meetings, 3 seems very reasonable. But the equity market didn't really care because, sure, the macro side wasn't as supportive as people were hoped for. But at the same time, Q4 earnings start to come out, and all the big tech companies beat expectations. Not just on revenue, a lot of them on earnings, and are forecasting weaker rebound this year, but still very healthy outlook going forward. So that really boosted the market. And on top of that, we all know as participants in these markets, there's just so much money on the sidelines, so much money. And people are waiting for a signal from the Fed for a real turn to start deploying these cash into riskier assets. And it felt to me that people just didn't want to wait anymore, and they need to deploy something. And instead of maybe locking it up for a longer term, I just deploy into maybe some fixed income assets and equity markets for liquidity reasons, and that really supported the market. So overall, it's been a very positive, let's say, year to date, and with the FOMC guiding very cautiously around a potential cut in March or May, assuming 2 things happen. And these 2 things, I'm just going to quote Chairman Powell directly. One is a weakening in the labor market, and 2 is a very, very, and he used 2 varies, persuasive lower inflation. If those 2 happen, we're going to see a more dramatic move from the Fed. And the headline on that is we haven't seen it yet. The most recent labor market and inflation data that came out are opposite of what the Fed really wanted. Labor market is still very, very strong. We're at historically low unemployment rate. Earnings are hourly earnings are increasing on pace with inflation. So your spending power is not dropping. So that's why people are still sort of spending despite piling on more debt, with the expectation that rates will come down, so that the debt servicing costs will be lower, and the inflation is still sticky. Again, I want to be very cautious around that word sticky. It is coming down. Okay, it is. We're now solidly in the 3 handle for core inflation, but the Fed's target is 2, and we're still away from that. And core is stickier than that. For core inflation to come down 1.5% into where the Fed is expectation is, that will take a bit more. Maybe certainly slowing down in the labor market and people spending less, and just hitting pause for a bit to just readjust their leverage, household leverage and company leverage. So yeah, the Fed is not getting the signals they want to cut aggressively.
This seems to me, macro, taking a step back, that we've actually they're pretty close to sticking the soft landing, right?
Yeah.
There's a little more work to do, but the plane's tires are down and they're like a foot off the runway.
Yep.
Right? Isn't that kind of what's going on? Like, we went through this multi-year process, and it's such a slow journey that it's hard for people to take in the totality of what's actually happened. But that's kind of what the story is, right? That's the headline for this couple of years, is they did it.
I agree. I think the Fed has done a tremendous job in making this so-called soft landing happen. And people out there in the market really don't want to call this any sort of landing, because the fact of the matter is, if you look at where equity is, we're back to all-time highs. And
also there's politics in this, right? Like, if you say something good happened, you might be giving someone credit, and depending on which side of the line you're on. But taking all the politics out for a second, from an economic standpoint, this kind of worked out, right?
Yep.
Now, it feels like there's still a sleeping giant. I mean, you're talking about the tech companies outperforming. But the thing that everyone was waiting for the crash to kind of get, the next implosion was going to be commercial real estate.
Yeah.
And
absolutely,
that hasn't been as much in the headlines in this last little spell, probably outshined by the stock market and everything else.
Mm-hmm.
But that's still there, right? Isn't it kind of like still a coming bomb? Or is it being diffused?
Yes, it is. I'm very confident that particular market is not being diffused, because you really are facing multiple problems at once. You not only are facing a demand problem, which is what a lot of people are talking about. The more major problem is actually on the financing side, on the liability side of these assets. And basically, banks and private equity funds that own these assets are having a very tough time refinancing these assets out of basically bankruptcy. And the math is very simple. You used to pay, you spend 10% locking in these short-term loans that are floating, and now you're trying to refinance. Your original refinance expectations, that's going to come back down to 5% as rent stabilizes, and rent is not stabilizing. And on top of that, you're paying still 10% for the next 10 years. So the equity gets wiped out, liability gets impaired. So these things, and especially
what
if you're
happens
a bank
then?
that's holding.
What happens once the deal crashes?
Yeah.
What do they do?
Depends on who the ultimate holder of these assets are. And unfortunately, I have to say, a lot of the holders are sort of regional banks, right? We saw the regional banking crisis last year. That's the reason why I really personally think, and a lot of people are saying the same thing, that the regional banking crisis is not over yet. Because last year it became a crisis because of treasuries. Because these are, treasuries that they're planning to hold to maturity, but there's some, there's a bank run, so they have to sell it. And now we're moving down in the balance sheet. We're moving into even more illiquid assets. And these assets are not being marked to market yet. If they are being marked to market, a lot of banks' balance sheet will be upside down.
And once they're upside down,
it's not going to be.
It's a consolidation trigger, right?
Yep. And you will need some type of rescuer. Again, this time for reals in a much bigger chunks, because commercial real estate, this is a multi-trillion-dollar sector in the economy. And it's not a blip, right? It's not something that you know that will kind of recover next year. It's more of a change of lifestyle situation where it could stay this way for the next 10 years.
Right.
So it's very
what
difficult.
do you do? What do you do if you're Powell or the government to create a soft landing in commercial real estate when you know that occupancy rates are just permanently way down with all likelihood?
Yeah.
You got to do a whole reset. How do you do that?
There's not much they can do on the demand side, put it that way. But what they can do is for sure on the refinancing side. So I'm sure this enters into equation. I don't know how the weight of this, how much this matters in their overall decision. But when they think about cutting rates and the pace of cutting rates, this directly feed into your mortgage rates. I don't know if you saw the headline, but about a week ago, our current 30-year mortgage rates, average mortgage rates for the nation went back up above 7%. Okay. At the peak, we're almost at 9%, and it came back all the way down because of, expectations on rate cuts and to 5 handle and 6 handle. And now it's back to 7%. Okay. So that directly impacts the refinancing options that these real estate have. So for them to feel, for this entire sector to feel somewhat of a relief, they need these refinancing options to come down to mid-single digits, not high single digits, and mid-single digits. And that, a lot of it is the trigger. There's a sort of an inflection point where it will make a lot of these projects a bit more profitable again, so that it can at least become self-sustainable despite the drop in occupancy rate. Or at least give them the option, give these sort of real estate holder the option to convert, right? Some of the commercial real estate that probably will never be needed again into residential real estate. But all that takes time. You need financing for that to happen. So there's only so much the Fed can do in terms of helping them before it goes into default. And once these properties do go into default, then you're looking at a much bigger rescue package, potentially not coming from the Fed, but also from the Treasury, some type of collaboration, and the private sector in terms of private equity.
Do you think the U.S. government rescues again, or is this there's just a point where it's coming? Every time we do one of these rescues, right? We build up the national deficit. Debt levels go crazy. My understanding is the medium-term byproduct is increasing disparity in wealth.
Yeah.
Right. The richer get richer, and no one else really benefits. Just the way it all shakes out. Or do they let something fail? I mean, it's not that we never do, but we never let the big guys fail. Is that on the table, or are we just about to see like the fourth cycle of the same repetitive history?
This is this is where you have to talk about politics, because it's all about that. It just happens to be a lot of the holders, the ultimate. I'm not talking about the immediate holder of these real estate, because they could be private equity funds. The ultimate holder of these funds are of this sort of potential collapsing real estates is actually U.S. pension funds. And if you're going to let the question really is, will the Fed, will the Treasury actually let pensions fail? And I personally,
my personal view, they'll just have a bad return, right? So
these are, we're talking about a potential.
Oh, you're saying they're going to miss payments. Yeah. So that means you've got a lot of folks who spent their whole life working.
Yes.
And the government's going to, the pension's going to miss payroll.
Correct. Or significant, or they have to do something, right? They will probably delay. The one way they do it is they delay the reimbursement age, right? So instead of paying you at 65, paying you at 70, or they pay you 70% what they're supposed to pay you. They're not going to cut your paycheck, sort of stop the paycheck, but they can potentially cut.
It's harsh. Really harsh.
Will the taxpayers ever let that happen? I don't think so. So it is definitely snowballing a little bit here, and it's making people nervous. That this is sort of a time bomb, and really no one knows that.
Right. So we're close to sticking a soft landing, but there's some dynamite in the airfield somewhere.
Yeah,
that's kind of what's going on.
Yep. And just give you another data point on this, because I'm not sure if you know this, but we're potentially looking at an office in Midtown Manhattan, and for maybe a couple of quarters down the road, but we're sort of learning the market as we speak, and it's currently Midtown Manhattan, class 1 buildings, class A buildings. So these are top of the line sort of office buildings, are quoting at something around $75, $80 per square foot. A couple of years ago, that was at 100 and 120, right? Depending on obviously the building, but we're talking about 20-30% drop in the best market, in the most supported most sought after market in the US in commercial real estate. Okay. I can't even imagine what San Francisco and, these markets are like. So it is coming down. It is coming down fast, and that hit a lot of people, and the returns.
All right, Chris, thank you. Great update.
Of course. Always a pleasure, Mark.
Quick reminder for everybody, Chris is an SEC registered RIA, so nothing he's said should be misconstrued as investment advice. As always, awesome to have Chris on. Get the quick update on what's been going on in major market dynamics. And I think we're looking at different ways to dive into some of his private wealth expertise as well. So it might be a little bit of a topic shift and variance coming up, which I think should be pretty interesting. Stay tuned.